Hello, everyone, and welcome back to the Trev Mortgage channel. I'm Trevor Higgins, and I'm here to talk about a topic that can influence all of us, including the economy, and that's the Fed or the Federal Reserve rate cuts. What are they? What do they mean? How is it going to affect home buying, potential home buying, mortgage rates? We're going to dive in on all of that today. So stay tuned, check it out, and let's learn a bit about the Federal Reserve. First off, what are Fed rate cuts? What is the Federal Reserve? Often just called the Fed, the Federal Reserve is the central bank of the United States. They control monetary policy, or the Fed's fund rate, which is actually the rate at which banks lend each other money overnight to make sure they balance out their books. When the Fed cuts this rate, it has a ripple effect because it makes lending money from bank to bank cheaper, or if they increase the rate, it makes it more expensive. One of the main ways they like to curb inflation is by increasing the rate. We're going to get to that a little bit more shortly, but if you like this content, please make sure to hit that like button, share it, and subscribe to my channel for more about mortgages, real estate investing, and everything you can learn about real estate. So let's get started. So, how does the Fed's fund rate influence mortgage rates? Well, it's not exactly a one-to-one correlation. In fact, the Fed's fund rate doesn't directly impact mortgage rates at all. Um, but there's a definite connection between the two. When the Fed cuts rates, it tends to drop all interest rates, including mortgage rates, making it more affordable for you as a home buyer or potential refinance if you need to debt consolidate, or maybe you just bought at a little bit of a higher rate and you need to lower your payment. It makes that possible, increasing affordability for all home buyers. So let's talk about why the Feds would want to cut interest rates, and that is to stir up economic activity. So we just got out of a season of high inflation, and the Feds rose or increased interest rates. And the biggest reason for that is because if it costs more money to lend, interest rates are higher, people spend less money. There's less purchases for cars, there's less purchases for everything because interest rates on credit cards, interest rates on personal loans, they all go up. And that's the one way the Fed uses its monetary policy to influence inflation and to control inflation. Now, why would they decrease interest rates? To do the exact opposite. If money is less and it costs less, then you're more likely to spend more money and you're more likely to buy more things. It stirs up the economy. And the Feds watch a lot of economic indicators. These things can be unemployment, interest rates, overall GDP, economic growth. There's a lot of different indicators that the Feds keep an eye on to make sure that their policy is doing what they want and driving the economy forward. Now, a lot of times they get it wrong. And the reason for that is because the Feds are always looking in their rear view window. What I mean by that is they're looking behind. So they're looking from at data that's maybe a month or 2 months old. It's not current. And can cause a lag effect in their policy and what they do versus seeing it in action and seeing it curb inflation or stir up economic activity. Now, I wanted to take a second to interject, and the Feds lowering their interest rate are not the reason why we saw historically low twos and threes a couple years back. And the reason for that is the Feds actually started to buy mortgage backed securities. So mortgages are packaged together and sold as a security. And as they purchase those securities, this caused what we call a technical short or shorting the market. So there's a lot of purchase activity, and it actually brings mortgage rates down. And they kept them low. They kept them low for a historical period of time. Most people got used to seeing this twos and threes. So when we see six and sevens, it's a little bit scary. It's a little bit weird, even though in a normal, healthy economic market, about a 5 or 6% rate isn't a bad place to be and should be about the average. Of course, it's important to note that the Fed's rate and mortgage rates aren't always a straightforward relationship. There's a lot of other things that can impact mortgage rates that may not impact the Fed rate. And that's global economic activity, potential conflict worldwide, economic disruptors, for example, COVID and a pandemic, things like that that can put a lot of strain on the economy or change the economy, are always going to affect mortgage backed securities and therefore mortgage rates. Why? Because mortgage rates are actually determined by the buying and selling of their security or mortgage backed securities, otherwise known as MBS. And those securities, depending on if they're purchased, sold, oversold, overpurchased, will determine interest rates. So there are other factors that go into determining mortgage rate. In fact, Fed's fund rate typically isn't a massive mover unless we're in a really hypersensitive economy like we are today and like we have been for the past couple of years. So, what should you do in light of the Fed's announcing interest rate cuts in next year and what that means for you? First of all, if you're a potential home buyer, this is a great opportunity to explore your options. Let us take a deep dive and see what you qualify for. Why are you saying that right now? Interest rates are still high, Trevor. Great question. Because buying now allows you to avoid the competition of later. So, what I mean by that is, as interest rates continue to go down, I believe that they're going to continue to go down and we're going to see a lot more competition or a lot more demand spike up, especially this summer, the summer of 2024, in case you're watching this later. I think that activity is going to spike demand because interest rates are coming down, allowing you to get a better deal today than you will be able to get in, let's say, 3 or 4 months. So if you're thinking about buying, great opportunity. The other side of that is maybe you purchased already and you have a higher rate. This could be a great opportunity to do what I like to call your mortgage checkup. Going through your mortgage, seeing if there's any opportunities for you based on life changing, based on your current financial goals. Because when you bought your home, your financial goals may have changed, and we want to make sure your mortgage is always meeting your financial goals. But this is a great opportunity to see how this rates and the Fed rate cut can impact your ability to buy or refinance on your home loan. So, overall, right now, in the hypersensitive economy that we're in, the Fed rate cuts, or let's say they decided to increase, even though they announced they won't, those are going to have an impact on mortgage rates. But this isn't the case. So, as we wrap up our explanation on what the Fed is, what their rate cuts do, and how they affect mortgage rates, keep that in mind. Is always have a great licensed mortgage professional. If you're thinking about buying a home, it truly does matter who you work with. And you want to make sure that you thumbs up this video and subscribe to my channel for more information about mortgages, how to save money, what the Fed rate is doing, how it affects mortgage rates, and everything there is to know about real estate and real estate investing. So hit that subscribe button if you like this content. Go ahead and drop me a comment in what you learned about the Fed rate cut. And if you'd like to see a content about something else in consideration for in connection to real estate or mortgages, let me know. I'd be happy to take suggestions. Reach out. Let me know how I can serve you. And I hope you have a wonderful, wonderful week. And let's kick off 2024 with a bang.